in the 21st century. Hard-working people working hard for you and me. Moving higher, time and time again. Through the years you'll find us here. Moving higher.
Hello and welcome to Moving Iron Podcast Markets with Shawn Hackett. Shawn Hackett is with Hackett Financial out of Boca Raton, Florida. And this edition of the Moving Iron Podcast is brought to you by Dawsontire and Wheel, your premier ag tire and wheel provider in North America, helping people grow. TractorZoom, delivering insights. And Dryshod Boots, the official work boot of the Moving Iron Podcast. Shawn, how you doing this morning?
I'm doing really good, Casey. It's a Friday, and we always try to see how things close the week out. So we'll find out today. So.
Yep, we will definitely find out. So, a couple things this week of some magnitude to the market. We had an ending stocks report come out on Tuesday, and we had the Thursday export report come out. And I don't know that the ending stock reports had everyone kind of flustered with how much corn we had and this, that, and the other thing. I think people forget that we have an ethanol industry that is going to rebound as soon as people start driving again, and we're starting to see signs of that. More and more ethanol plants are opening up. Price of ethanol is going up. Gasoline futures are going up. Price of oil is going up. I mean, everything's going up. Just, I don't know if the doom and gloom media has yet to remind people of that, but it's still the worst thing ever right now, and there's a lot of stuff going on that shows that there's some bad stuff happening, but silently, positivity is creeping back into the market. So I guess, Shawn, as you take a look at the export report and the ending stocks report, what's your reaction to those, and then what's your reaction to this week's trade?
Well, first of all, the May USDA report is always, as long as I've been in the business, has always said we have too much corn. I don't recall a May first estimate from the USDA saying anything other than, we're going to have too much corn. So every single year, you can bet the May report's going to tell you we have too much corn, just using the corn market as an example. Mm-hmm. So they came out in this report and said, we have too much corn, like they do every single year, and everyone's bearish this time of the year. I remember how bearish people were a year ago. Too much corn. Rain makes grain. Too much corn. And then we rallied over $1 within the next 30 to 45 days. So the USDA, it's a balance sheet. It's a spreadsheet. We actually don't have the 3.4 billion bushels to carry out. That's what they suggest we're going to have. But it doesn't mean it's real yet. I mean, it doesn't mean that's actually. We still have to grow the crop. We have to harvest the crop. We still have to look at the. I mean, that's just a proposition. That's their guess, and they're never right.
Yeah.
The May report is never ever the way it turns out. So if anyone says, "Look at all this crop," no, we don't have it yet. It's a speculation, and it's my job, your job, the job of the farmer, to speculate. Are they right or wrong? And if they're wrong, which direction are they wrong? And so when we look at that report, we think we've just traded the largest corn supply number we're going to trade probably for the rest of the year. That's our guess. We think that they're totally overplaying the loss of ethanol demand. We think they're completely overestimating how many acres are going to get planted. Or have been, or in the process of getting planted. We think that they're overestimating the yields that they're going to have based upon how we're already starting off the year. Just a lot of things that we think they're just, and this is typical. They throw out the most optimistic numbers because that's just how they operate. But we believe the corn market looked at that report and said, It actually went up that day, I believe. I think it went up 2 or 3 cents that day. So when the market doesn't go down anymore, Casey, on what appears to be numbers that are catastrophically bearish, the market's kind of either priced it all in, more than priced it in, or actually doesn't agree with the numbers, because if they did agree with the numbers, we would have gone down quite a bit. So all this is to say that we think that going forward, we're going to keep chipping away at this 3.4. You keep chipping away at it. Oh, ethanol demand is coming back faster than we thought. Oh, exports are better than we thought. Oh, we got hot, dry weather, or the weather's not as good as we thought. The June report comes out for acres, and we didn't plant quite as many as we thought. The farmer actually, did decide not to do it this year. I mean, we could go, quarterly grain stocks. Last year's crop was overestimated. We have less old crop stocks than we thought. I mean, we can go down the list of all the things that I think that will start to chip away at this 3.4. And by the way, this is not. It doesn't mean that we're heading for $6 corn.
Right. No,
there's a very big difference. Right. I'm not sitting here saying $6 corn really comes, but I'm saying sub $3 cash corn, I do not believe is a correct pricing at this moment in time based on what we see fundamentally and what's likely to be the reality, and also at the capital flows that we follow, the smart money algorithm that we follow, we've been following forever, and it's been really, really good on corn. It's given us our first smart money buy signal in over a year. And it's been a very, very good indicator. That's to say that collectively, the smartest people in the corn market, whether it's ADM, Cargill, China Trading House, an ethanol operator, it's all of them combined, have pushed their money to the long side in the largest amounts in over a year. And so, they're not always right, but they're right a high percentage of the time. And so when we see them really pushing in their money, skin in the game, we call it, they're worried about upside surprises in corn prices right now. They're not worried about the downside. And I agree with them. And I think that when right now, we've talked about this before we started, there's very low volatility in corn. 2 cents up, 2 cents down. It's quiet, sideways trade. It's almost like the market. Is it open today? Is there a problem? Call a CME. Open up that corn market. It's just so quiet. They always say never short a quiet market, because usually when a quiet market wakes up, it wakes up to the upside. So to those that are out there that are feeling depressed, or they're thinking there's no hope for corn market specifically, we think this is a pretty good time to be a little more optimistic about a move higher in price. We have to determine how high that price will be, but whatever it is, we think it'll be a worthy move that will provide the farmer an opportunity to sell a price that makes a whole lot more sense than it does right now.
I absolutely agree with you 100%. I've been watching this, and it's just like you said. I feel like they've forgotten about ethanol. And how much corn goes in ethanol, and the reason ethanol plants are shut down has nothing to do with lack of demand or lack of supply or able to create the supply or anything like that. It's just the fact people aren't driving, and more people are driving now. And
let me here in where I live, we're a very high population density area. Okay? I mean, on a normal day this time of the year, there's cars everywhere, right?
Yeah.
So just anecdotally, now the last couple of days I've driven around, and the traffic is crazy like it normally is. If I didn't know that we just went through this shutdown, if I just woke up and went out about my day, it was a normal day on the road, traffic everywhere, waiting at lights, people yelling, screaming because you're too slow. Every car's on the road.
Right.
Every car's on the gas stations are full. You got to wait to get your gas. Mm-hmm. So I am sure I'm not in a bubble here that we're the only area experiencing dramatic increases in demand for gasoline based upon normal driving behavior and activity. Yep. I am sure the rest of the country, at least a good portion of it, is experiencing, which means the demand for gas, the demand for oil is rapidly moving up, and that means that the demand for at least 10% of it, it's got to be ethanol, is rapidly moving up.
Yep.
And that means that unless we start producing some, those large ethanol stocks are going to crash as fast as they can.
Right. Yep.
So that's how we see it.
It's logic, right? There's there's the correlator. You know what I mean? Like the price of, you want to look at gasoline futures and the correlation between gasoline futures and ethanol futures. They've both started to rise at the exact same time. You know what I mean? What am I missing here, right? So there's a correlation between the two. So that kind of leads me back into my next thing. I want to talk to you about energy, kind of spend a little time there. As you look at the overall price of oil, there's been about a $60 swing from I'll give you $38 for that if you just take this barrel of oil from me, to now it's worth about $30. So there's been a huge swing in the price of oil. Obviously, that goes back to the amount of cars back on the road driving around, what that looks like. I did some rough math the other day, and I came up with something. I'm going to probably butcher this now because it was last week when I came up with these numbers, but something like 389 million gallons of gas get used a day in 2019, if I remember right, something along those lines. And that would have created if half those open back up and the ethanol that comes with it, we basically have about a 60-day supply of ethanol if half the people start driving again. So as that creeps up, we're going to start seeing it going. Ending stocks for ethanol typically, even in good times, are as full as they can keep them, just because of the amount of time that it makes ethanol. So as you look out and you're looking at the oil market, $40 oil is not that far away.
I mean, I think we could be there very, very quickly. At the current rate of demand that I'm seeing, at least in my area, and I know my friends that I'm talking with in other areas, we could see $40 barrel oil, within the next 30 days. Wouldn't surprise me at all. I mean, we're only almost at 30 already.
Right.
So 40 is not, here we go. But I mean, $40 a barrel, that kind of level of demand to get back to 40 means we're going to get a lot of ethanol demand back for corn, and what that means in the local market, it means the basis is going to narrow. So the two things are going to happen is the actual futures price is going to start to rise in that scenario, and the basis, which just blew apart, as you know, because everybody backed away from buying corn, but the basis is going to improve. So you're going to get a double whammy of a basis contraction, and the market's going to go up at the same time. And so you could be looking, even if the corn price, went up 30 or 40 cents, and you got a 20-cent improvement in basis in certain areas. I mean, that's a dramatic turn of events for cash corn, from where we are today to where we could be 30 days from now on a just a little bounce in the corn market. I mean, nothing that would even show up as anything major, just going back to resistance. You know what I'm saying?
Yep. Yeah. It's not going to take a lot to turn the tide right now. I don't think. I think we're right there on the cusp of just a few things need to fall in place, and we're going to not crazy rise, but we're going to start seeing things move.
Yeah, and the longer term picture too is, remember, we've blown apart the funding of the fracking industry, right. Meaning Wall Street that was funding all this activity, even if they were losing money, the money was coming. Don't worry, you got all this money that fostered all that. Rig count growing and everything, it's over. I mean, that spigot is gone. So even when we get back to $40 or $50 barrel oil, there's no appetite for Wall Street to fund anything. So it's not going to be immediately going back and capital programs and let's expand again. We're just going to be, let's operate efficiently with what we got. Let's start paying some debt down, but there's going to be no expansion that we can see anytime soon from Wall Street funding new expansion for a long, long time. So that means that the supply-demand equation for crude oil and for natural gas for the oil patch in the United States is going to be snug for a very, very long time before the balance sheets improve, before Wall Street gets more excited again that maybe certain projects can get refunded again. But that's way out there in 2021 in our view, and that's really actually very optimistic for the ethanol industry. That's not going to be a blip up, make a little money, it's going to come right back down. We think it's up and it sustains itself for an extended period of time.
Yeah. All right, so let's jump over and talk about the dairy market a little bit here. Dairy market is one of those ones that got probably the hardest hit from this coronavirus thing. The amount of dairy products that weren't getting made because of restaurants being closed and those kind of things, the amount of milk that was getting dumped, and all those fun headlines that we saw over the time have kind of started to change a little bit. Dairy market's been limit up here the last couple days, and looks like it's got some opportunity to continue basically because things are opening back up, right? There's getting some demand back into the restaurant side of things, and that the cheese market and those kind of things are really driving that. So talk about the dairy market a little bit and what you see happening there.
Well, dairy market is a perfect example of dairy is probably the market where participants get as bearish as I've ever seen in any market. Even the corn market, bearishness, that's optimistic compared to how the dairy guys get. They get really, really bearish. Yeah. Okay? And I can tell you, in April, it's no restaurants ever going to open again. We're done. This price level, there's no hope for a rally. And then guess what happened? Our smart money algorithm triggered a buy signal, like we talk about the smart money, like corn. And then guess what we started to do? We started to reopen the U.S. economy, and now some restaurants are opening. And what do they have to do in order to open a restaurant? You just can't have nothing on hand. You have to restock, right? You have to restock dairy products. Yep. You gotta buy some cheese. You gotta buy some butter. You gotta get some of the stuff in because you just can't have one day's worth of butter and hope tomorrow. You're gonna have to buy 30 days of butter, whatever. However they do that, it's gonna. So all of a sudden we got this influx of demand from all these restaurants that had to say, look, if we're gonna reopen, we need to buy all these dairy products. And then the government came in and said, we're gonna help out a little bit, and we're gonna buy some spot product on the market for reserve, for food banks, to help the spot market out a little bit. So these two demand side confluences came together at the same time and caused a whipsaw. And actually in the August contract, if you can believe it, is now back to where we were pre-virus. As of yesterday's close, the August Class 3 contract is back to where it was before the virus panic began, if you can believe it.
Yep.
So how quickly things can change. That can happen, and I wouldn't surprise me, Casey, that if many other markets, ag markets, that we will look at over the next 30 days might go back to where they were pre-virus panic. In fact, when we went back and did the studies of past pandemics, and market reactions, we found that it actually is fairly commonplace for a lot of markets to go back to where they were before the crisis began. So milk probably is the first one to have done that. And so now more going to follow. But I just think it's remarkable when you think about what was being talked about in the milk market just 2 weeks ago, and now we're back to pre-virus levels. It's telling you what can happen when sentiment shifts in the marketplace, and why we're being very clear to everybody. I would back off the bearish sentiment right now. I'd keep an open mind, because the flip side of the pandemic crash is going to be surprising upside. And the milk market is just a classic example. I am very happy, by the way. I am thankful that my customers are getting a chance to sell a price, that has more reality, basically more reality to their operations. I'm really thankful that we've gotten this significant surge, and it's going to help them a lot. And I expect to see that in the corn farmers and soybean farmers and cotton farmers and all. I think there's going to be opportunities to get a price that maybe it's not the price that you ultimately would love to see in the long run, but it's a price that you could say, hey, you know what? That'll work for me. That'll work for me this year. So, and I could buy that piece of equipment from Casey that I've been wanting to.
I hope that's true. I hope that's true. All right, so let's jump over and look at the livestock market here. If you look at the last 2 days of the week, last week cattle were limit up, and they've had a fairly decent run this week. Obviously, pork is still one of those ones that's just struggling to get a footing of any kind of magnitude. But I guess talk about that a little bit. We see happening there.
Livestock, cattle and hogs are a little bit of it's a little different than dairy.
Right.
Dairy never had a throughput issue. Just dairy had a short-term demand side issue. Yep. Once the demand came back, everything was fine. The demand is there for pork. The demand is there for beef. It's a throughput problem, and the daily swings in the marketplace, especially for cattle, has a lot to do with this plant's going to come back or it's not, or throughput. It's really hard to gauge the short-term moves right now because it's all predicated on the perception of how this throughput is playing out. There's people that say, well, the maximum is going to be 80% capacity for the rest of the year. And if that's the case, then the throughput really can't be enough to overcome the backing up of animals. So when people start believing that, they knock the market down. We're not in the camp that says 80% is the best they can do. We believe that over time, the profits are so enormous at these packing plants, they'll find a way to get back to 90% at least, which is what they need to get back to in order to create a more normal flow and to get the price of animals back to where they need to be. So for now, what it looks to us is that the cattle market made its bottom. It spiked out of that basing pattern. And, it looks to us like the cattle market has placed the lows. The hog market is still in search of. And I think the biggest difference is, cattle, if you back the cattle market, you can put them out pasture, you can slow down your feed, they can gain some weight, you can find a way to push them off a little bit. But in the hog business, you can't do that.
Yep.
And they're ready. Either you euthanize them or they go through, but you have the ability to, hold off, little piggy, don't eat anymore. I mean, they just grow so fast.
Yeah.
So I think that's why hogs have been unable to come off the bottom like cattle, but they're going to have their day. What it means is euthanizing all these pigs, Casey, means that there's going to be quite a supply vacuum in the in the fall, because all these animals are not going to be there, and there's not going to be the replacements for them. We could have quite a supply issue. It's just they're still getting backed up right now, and the market's suffering because of that.
Yep. So. There has been more talk about the Phase 1 China thing now than there was in the 2 years that we were waiting for the deal to get done, and there's been threats back and forth between the Chinese and the U.S. back and forth. But the more that you look at that deal, I guess the more you realize there was holes in it to start with. I guess China's not doing much. They are. No, I'm they're not doing anything. They're buying corn. They're buying some beans. They're buying some hogs. They're doing some stuff like that, but nothing to the magnitude that we see that Phase 1 was supposed to be. As you look at that Phase 1 Chinese deal, what's your thoughts on that?
There was no monthly target set that they had to do anything in a particular month, Casey.
Right.
So they have time to still deliver. And I think that they're just waiting it out a little bit to see how Trump politically makes out with all of this virus talk and the elections coming up. I think they're just trying to gauge whether they think he can get in or not. I think if they make the decision he's getting back in, you'll see wild, crazy numbers. Either they can't deliver it in the current year, they'll say, look, we booked them, that sort of thing. Mm-hmm. The other thing that I think that they're monitoring is this time of the year, they can buy a lot of product from Brazil,
right.
And I think that they're looking at what's going on down there with the virus because it's proliferating down there.
Yeah.
It's out of control.
It's blowing up.
It's blowing up. Their weather conditions, their temperature conditions are getting the ideal weather for community spread. Bolsonaro doesn't believe in social distancing at all, that everyone just go around kissing each other, which is fine if that's what they want to do. But the numbers are saying it's getting out of control. The hospital system is already overrun. And I think they're also saying, that situation could go from bad to ugly, where there may be chaos there for a while, and they may not be able to ship out corn and soybeans for a while. And I think if the Chinese get worried that those supplies that they're counting on may not be reliable, they're going to come in and really, really buy U.S. product as well. So I think those two factors, the political temperature of Trump and how Brazil's doing as we go into this export period, will have a lot to do with whether they just keep buying, a little bit, or they really put the pedal to the metal and buy a lot. We think they're going to, one of those two things, and or both, are going to give them cause to start delivering on the numbers that they said they were going to, and it'll happen overnight. It'll happen very, very quickly. And maybe that is what smart money is seeing here. Maybe that's why smart money has been buying corn as aggressive as they have. Maybe they know that is actually going to happen, or that's going to be coming. I don't know that. You don't know that, but maybe somehow They do.
Yeah. Now, I spent a lot of time in the last couple of days just watching and reading news out of Brazil about the coronavirus and what they see happen there. You're right. Barcelona is the zero. He's like, ugh, whatever. We're the famous, one of his famous statements that he made was, don't worry about the coronavirus. We Brazilians have strong immune systems. I'm paraphrasing, but it's something to that effect. And I'm like, wow, that's a bold statement to go out and tell your public that don't worry about it.
Someone asked him a question. Right now you're on track that you could have, hundreds of thousands of deaths at the rate that we're going. They're
right.
Getting for at least 100,000. And he goes, well, that's just the way it goes.
It's an awful thing, man. I mean, it's awful, but, it's just that his brashness about what he sees happening there. I mean, God bless him. I mean, as awful as it is to say, what if that does happen in Brazil and Brazilians strike for as a hobby, I think. So if they get a chance to go on strike about something at the port, or trucks aren't going to drive, or whatever it is, or farmers just flat say, don't come out to my farm and pick up my crop right now, I'll wait a minute. I'm with you on that. The Chinese are going
to. He's even talking about using military action to force farmers to do stuff. I mean, it's getting really ugly down there, and I don't know. I'm thinking the chances of some destruction down there is increasing by the day, and I don't see the grain markets having priced anything that even might be a possibility yet. And should it start to worry the market? I mean, I don't think it takes a rocket science to figure out what our markets might do if they're thinking that all these exports out of Brazil may be offline for a while. I mean, it would be a pretty crazy situation.
Yeah. And the Brazilian market too, and Argentine market, they're not necessarily the best crops they've had in a while. I mean, especially in Argentina, every week they come out almost and downgrade the crop condition or the number of bushels or whatever it is. They've done that about almost every week for the past 10 weeks. And there's couple that with other stuff that's happening, really there's an opportunity there to see some large swings in the marketplace.
Well, yeah, I mean, they did not have big buster crops this year, for sure. And look at the Argentinian peso, crash and burn.
Yep.
Look at the Brazilian real, crash and burn. Now, normally, right, that would be bearish to the U.S. price, and it has been. But what starts to happen is the farmers says, wait a minute, I'm just going to the only thing I got is this asset called corn,
right,
or this asset called soybeans. I'm keeping it in the bin because with this inflation going on, with this crash in the currency, this is how I keep my buying power, because I can't put it in the bank because the currency every day is worth less. So that mentality, this currency inflation mentality, which we've seen in Argentina for a long time, they store a lot of soybeans as a hedge against inflation, keeps stocked up the market as well. So all of this is saying that the supplies coming out of South America may not be as robust as we've seen in recent years, and that may be something the Chinese start to pick up on and go, hey, you know about that trade deal, U.S.? Well, we always loved you. Here we come.
Yeah, it's kind of like me in college. You have a semester to finish this project, and I'm going to do it the last 3 days before it's due. So I feel like that's when I see what's happening with China, and I look at what's going on there. Obviously, there weren't anything in there that said, hey, in January you got to buy this much. Just like you said, there was no like monikers they had to hit, right? But they just have to buy it. So they could come to the market in October and say, you know what, we'll go ahead and buy our however many million metric tons of whatever we're going to buy, and we'll just go ahead and get that booked now, and we'll have a February delivery date or something like that. I just think that I just don't think the stuff in Brazil is going to go as well as they think it's going to. And not that I'm an expert by any means, but just from what I've read.
Well, we're very concerned because our work on the virus and what really made community spread occur, whether it was New York City, whether it was Seattle, whether it was Wuhan, whether it was Northern Italy, we'll go down the list. It was always that the temperatures got in this 35 to 65 degree level, and you got into a we had lower sunlight because of wintertime, and you had these cooler temperatures and drier temperatures. These are the conditions that this particular coronavirus loves to spread on, and that's the conditions that South America is now entering into for the next 3 months. And in Brazil's case, they are not taking reasonable precautionary social distancing measures. They are in Argentina, but they're not doing it in Brazil, which says, it could get very, 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 very ugly there. And I'm not wishing upon that on anybody. And their healthcare system, as much as we complain about the U.S. and we weren't ready, and our healthcare system compared to Brazil is quite a bit better. So, we just think the market should be pricing this risk in, and they're not. And that could be what just wake up to one day, and all of a sudden all you're hearing about is how Brazil is striking and the ports are closed, and China is now buying, half the corn crop of the U.S. because it has to.
Right.
That's
Yep. All right. Last thing, then we'll shut it down here. Wheat is showing some signs of life here. Eastern Europe, Western Europe, Australia kind of bounced back a little bit, but they're kind of turning off a little bit drier now that they got all that rain that they've gotten. But the Black Sea region of the of Europe and over in Russia and Kazakhstan, those areas are showing some major signs of drought. I mean, epic drought, and they're tearing back the exports they're going to have. Ukraine just had a thing that they're tearing back their exports by 25 to 30%. Russia's talked about the same thing. The U.S. wheat market now, we're in full swing of harvest down south, making our way north, and it's one of those years where it's either really, really good or really, really bad, just depending on where you're at. And so there's going to be some volatility in the marketplace there. Wheat has an opportunity to grow and shoot up the ladder in value a little bit. As you look at the wheat market, what are some of your concerns and what are some of your optimistic outviews?
Well, we actually rallied a lot, as you know,
yeah.
On the stockpiling idea, on these weather problems. Half the world got concerned about food, and so they, let's get some wheat bought. But then harvest comes, right? So you always have harvest pressure. No matter what the case is, you start to harvest, you get harvest pressure, and so the market has given back and corrected a fair bit, like you would expect it to as harvest gets going. But that's now happened, right? We've had that correction now. But the weather problems, the constricted supply, the worry over food supply, none of this has gone away. And so we think that we've kind of traded the harvest pressure period, and we're now ready to move into what's called the post-harvest rally that you tend to get in the wheat market. And so we're pretty optimistic that the downside we were concerned about before has happened, and now we're starting to get some pretty good smart money algorithm behavior, especially in, like, say, Minneapolis wheat, which is the higher quality wheat. It's actually on a different cycle because it's being planted right now. So we actually think that the wheat market's in the process of making a secondary low here, Casey, and getting ready for another expression of all these things that made it run up the last time. It just needed a break. It needed a chance to rest and to handle some of this new supply that's coming in from harvest. With that out of the way, we do think that the prospects for wheat look better here as we move into June, July.
Yep. So, and speaking of dryness, I mean, if you look around, we had a pretty strong weather event roll through the Midwest and the plains here last night, and that dropped some pretty significant amount of rain that in some fairly dry areas in the middle of corn country. So the U.S. is not out of the woods when it comes to drought-like conditions starting to form.
We've said all along that this is going to be more of a hot, dry year, because we're moving towards La Nina.
Yeah, La Nina.
La Nina-like behavior.
Yep.
And it's only going to get worse next year as we get into a more full-blown La Nina. So the message for this growing season is that as time goes on, warmer, drier. In fact, what we continue to tell our customers, Casey, is that we haven't had a hot, dry August in a very, very long time.
Yeah.
And you're trying to think back when we had a hot, dry August. It's always been cool and wet, and it's been perfect conditions for finishing the crops out and that sort of thing. But if we were to look at what would be something to really drive the market this year, a hot, dry finish, August, late July finish, we think is very likely this year. And this would be particularly troublesome for the soybean market because obviously that's where soybeans make or break the yield that they're going to have. And so, we would be looking at a hot, dry finish to this growing season as potentially a weather event that might get things going, whereas in the last several years, it's been the front end that we've actually seen a back end loaded weather problem this year. And so that fits in with a hotter, drier, La Nina kind of summer that you tend to get. And that would be more problematic for soybeans. So that's something just to keep in the back of your mind on the soybean market. It doesn't affect the soybean market today, but starting in July, that's going to be what's really going to start driving things in the minds of the market of soybeans. And of course, if soybeans take off, corn isn't far behind.
Yep. So. Well, good stuff as usual, Shawn. We pumped out a lot of information on this one. So if folks want to reach out to you and get some more of that information, or maybe check in on some of your reports that you put out, what's the best way to do that?
Our website is Hackett, Hackett, advisors.com. Lots of information on there, Casey, to see if what we do might be of value to your listeners.
Right on. Check out those reports. Those things are worth your time. There's sample reports on that website, too, so check that out. I'm Casey Seymour with Moving Iron Podcast. Make sure you check me out on Facebook, Twitter, and Instagram for all the latest posts of the podcast as well as blogs. Also check out movingironllc.com where you can find all the information for the Moving Iron Summit in September 1 through 3 in Nashville, Tennessee. And you also get to hear Shawn speak at that as well. And he'll deliver a great message about what's going on in the marketplace. Also, you'll find the website. On the website, you also find the podcast as well as blogs too. So also check out the Global Ag Network and the great podcasters out there as well. So until next time, I'm Casey Seymour with Shawn Hackett. Let's go move some iron, folks. Out.
Moving iron in the 21st century.